So you want to own a taxi fleet. You have been in the back of one. Vinyl seat, divider, a meter clicking up, cash or card at the end. The driver does the work. You just own the cars. And the cars run 20 hours a day, 2 shifts, 7 days a week. You look at that and you think one thing. That is a machine that prints money. And you are right. For 70 years, you were completely right. In 1962, a New York taxi medallion cost about $25,000. By 2014, the average was 1.32 million. It beat the stock market, it beat gold, it beat almost everything. Immigrant families bought them as retirement plans. But there is a question nobody asked while that number was climbing. What exactly is a medallion? It is a small metal plate that bolts to the hood of a car. It is not the car, it is not the business, it is not even a license to drive. It is a piece of paper saying the government will not let too many other people compete with you. And in 2014, that piece of paper started falling. Today it sells for somewhere between $90,000 and $200,000. More than 950 owners have filed for bankruptcy. Here is the reframe that explains all of it. A taxi fleet is not a transport business. It is a leveraged bet on a government promise, and the cars are how you service the debt. So let us build it properly. What the plate costs, what the cars cost, what a driver actually pays you every week. Then the part nobody put in the brochure, which is that the crash was not caused by the thing everybody blames. Start with the plate, because it is almost the entire investment. New York caps the number of medallions. For years, the figure sat at 13,587. That cap is the whole product. Every dollar of value came from a promise not to issue more. Chicago did the same thing. Boston, Philadelphia, San Francisco, all of them. And every one of those markets ran the same arc. Chicago plates peaked somewhere near $385,000. They now change hands for under $50,000. Same collapse, smaller headlines. Then the vehicle, which is the part people wrongly assume is the expensive bit. A purpose-built taxi with a partition, a roof light, a meter, and a card terminal runs perhaps $40,000 to $60,000. Against a plate that once cost $1 million, the car is a rounding error. Then the running costs, and here the numbers are unforgiving. Annual ownership outlay for a single medallion runs around $22,000, mostly insurance and compliance. Commercial taxi insurance is nothing like personal auto cover. Cities commonly require liability limits of $300,000 to $1 million. The vehicle drives stop and start 20 hours a day in the worst traffic in the country. Brakes, tires, and suspension wear at a rate no private car ever sees. And then there is the accessibility mandate. New York requires half the fleet to be wheelchair accessible. Converting a vehicle can cost more than $75,000. As of last year, the fleet had reached under 45%. Now the revenue side, and this is the part that made it look so simple. You do not drive. You lease the medallion and the car to somebody who does. Historically, that ran roughly $100 to $150 per 12-hour shift. Today, the regulator caps a medallion lease at $952 a week, plus a separate vehicle portion. 2 shifts a day, 7 days a week, and the plate earns whether the driver has a good night or a terrible one. That is the pitch. The driver carries the risk of the street, you carry the certificate. And on current fare volumes, a single medallion throws off something in the region of $1,600 a month of net cash. Hold that number, because it is the honest number and it is about to explain everything. One more figure before we go further, because it describes the industry today better than any price does. New York still regulates 13,587 medallion taxicabs. In 2024, only 10,870 of them completed even a single trip. Roughly 1 in 5 plates in the city did not turn a wheel all year. They exist on paper and nowhere else. Now the invisible machine, because the interesting part of this story is not the crash. It is what happened in the 12 years before it. Between 2002 and 2014, the average medallion price went from about $200,000 to over $1 million, 5 times in 12 years. Now look at the other number over the same period. Driver incomes stayed flat. Stop and hold those two facts together because they should not be able to coexist. The price of an income-producing asset went up 500%, while the income it produced did not move at all. There is only one thing that can do that, not demand, not scarcity, credit. Scarcity was already there. The cap had existed since 1937, and it had not changed. Nothing about the streets, the passengers, or the fares justified a 500% move. Only the lending changed. Roughly 4,000 drivers bought medallions in that window, and almost all of them borrowed to do it. The loans were structured in a very specific way, and the structure is the story. Many were interest only. The borrower paid every month for years, and the principal never moved. Most carried a balloon. A large portion of the loan came due all at once, typically after 3 to 5 years. The pitch for that was simple. When the balloon arrives, you refinance, or you sell the medallion for more than you paid. Both of those depend on the price continuing to rise. The loan was not underwritten against the driver's income, it was underwritten against the appreciation. Then there was the clause almost nobody outside finance has heard of, a confession of judgment. The borrower signs, in advance, an admission that he owes the money and gives up the right to contest it in court. Congress banned that in consumer loans. It did not ban it in business loans, and medallion loans were classified as business loans. And the man sitting across the table from the driver explaining the paperwork was a broker. The driver believed the broker was representing him. The broker was frequently being paid by the bank. Loan applications were routinely inflated. One driver's application recorded an income of $128,000. His tax return showed about $25,000. Employees at lenders later described being pushed to write loans with bonuses, sporting tickets, and free trips as incentives. Drivers almost never had a lawyer present at closing. Now, who was selling the medallions into this market? The city. New York auctioned them, set the opening bids, and collected the proceeds. Between 2004 and 2014, 16 auctions raised $850 million for the city. Read that again slowly because this is the center of the whole thing. The same government that created the scarcity, regulated the lenders, and was supposed to protect the drivers was also the seller, and it was paid more when the price went higher. Every party in the room made more money when the number went up. Nobody in the room was paid to ask whether it should. Then 2014 arrived. Uber had entered New York in 2011. The measurable effect on cab revenue was a decline of around 10%. 10%. That is what the disruption actually did to the earnings. The medallion lost more than 90% of its value. An asset does not fall 90% because its cash flow falls 10%, not unless the price was never about the cash flow. The balloons came due into a falling market. Refinancing was impossible because the collateral was worth a fraction of the loan. Selling was impossible for the same reason, and the confession of judgment meant there was nothing to argue about in court. More than 950 owners went bankrupt. In January of 2019, there were more medallion bankruptcies than in 2015, 2016, and 2017 combined. 8 drivers took their own lives. 3 of them were medallion owners carrying loans they could not service. In 2019, the New York Times published a 10-month investigation by Brian Rosenthal. It won the Pulitzer Prize. A senior instructor at Harvard Law School's predatory lending clinic reviewed the findings. He said he could not have designed a more predatory scheme if he had tried. The mayor ordered an investigation. The state attorney general opened an inquiry. Federal prosecutors opened one into possible lending fraud. And note what all of that established. The industry spent years blaming Uber, and Uber made a convenient defendant. But the bubble inflated before Uber arrived, and it inflated on credit, not on rides. Uber did not build the trap. Uber walked past it, and the floor gave way. And the earnings damage kept coming after the collapse, which is worth being honest about. Between 2011 and 2019, taxi revenue fell about 36%, adjusted for inflation, closer to 44%. So the business did get materially worse. It just got worse by a third, while the asset got worse by 9/10. If this breakdown is useful, subscribe. It genuinely helps. Now the numbers, and there are 2 completely different businesses here, depending on which decade you bought in. Scenario 1, the version that destroyed people. You buy in 2013 at $900,000 with $50,000 down and the rest financed. Your medallion leases for around $50,000 a year gross. After insurance, compliance, and maintenance, call it $30,000 net. Your interest alone runs well past that. You are underwater from the first month, and you know it, and you do it anyway. Because the whole model assumes the plate is worth $1.1 million in 3 years, and you sell into the gain. By 2019, it is worth $200,000. You owe $850,000. There is no refinance, no sale, and no defense. Scenario 2, the same business, bought today. The plate costs $115,000. The car costs $50,000. Call it $165,000 all in. Lease income to a driver runs somewhere near $50,000 a year, gross. Take out the $22,000 of insurance and compliance, plus vehicle depreciation and downtime, and you are left with something in the region of $19,000. On $165,000 invested, that is roughly 11 or 12%, which is a genuinely decent return on a hard asset, and it is available for one specific reason. The price finally fell to where the cash flow could support it. The gap between those 2 scenarios is not skill, and it is not effort. Both owners bought the same plate and hired the same kind of driver. The gap is that one of them was buying an income and one of them was buying a story about a future price. And that distinction is the entire lesson of this industry. There is a version of this business that works right now, and it is worth being precise about what it is. A medallion at $115,000, generating $50,000 a year in lease income, is a rental asset with a sensible yield. Prices have actually risen 24% over the past year off the bottom. The city's relief program has restructured hundreds of millions of dollars of debt and capped many outstanding loans at 170,000. But notice what has changed. Nobody buying at these prices is telling themselves it will be worth $1 million. They are buying a cash flow at a multiple the cash flow can actually carry with money they can afford to lose. That is the only version of this that has ever worked. It just was not the version being sold. So who is this business for? It is for the operator who wants a modest, regulated, unglamorous yield on an asset nobody is excited about anymore. It is not for anyone who thinks the number is going back to 1 million. It is not. There are millions of ride-hail vehicles and autonomous fleets arriving behind them. And the real lesson is not about taxis at all. Any asset that produces a fixed income whose price rises 5 times while that income stays flat is not appreciating. It is being financed. The medallion was the purest example we have ever had, because the income was capped by law and printed in a public rulebook. Anyone could have checked. Almost nobody did. So the next time you are in the back of one of those cars, watching the meter tick up, look at the plate on the hood. Somebody paid $1 million for that piece of metal, and it is worth a tenth of that now. The only thing that ever changed was who was allowed to compete.